2 years ago, you were told a number, $8. That was going to be the most a bank could charge you for paying a credit card bill one day late. Congress did not pass that. A federal agency wrote it, finalized it, and published it. And then it was quietly killed in a courtroom in Texas by the very agency that wrote it, and almost nobody watching this ever heard the second half of that story. Right now, today, if you are late on a payment, most large banks are still charging you $30 for the first offense and $41 for every one after that. The $8 number you remember hearing about does not exist. It never took effect for a single person. That is trap number 1, and it is the smallest of the 4 I am covering today. Here is what I want you to understand before anything else. None of what I am about to tell you is a conspiracy. Nobody is hiding these facts. They are published, they are public, and they are also scattered across 4 different agencies and a dozen news cycles, which means almost nobody ever sees all 4 in one place at the same time. That gap between public and understood is where money leaves your account every single month. So here is what is actually happening with credit cards right now, and I am going to give you all 4 before I ask you to do anything. 1. The late fee number you were promised never arrived, and a new government inquiry into it just opened this summer, which tells you it is not settled. 2. There is a genuine, real improvement to how medical debt appears on your credit report, and there is also a very specific gap inside that improvement that has already damaged people who believed the whole thing was covered. 3. A payment method that was marketed to you for years as completely invisible to your credit score stopped being invisible, quietly, and most people using it still think the old rule applies. 4. Every point and mile you have been carefully saving is worth less legal protection than you assume, and there is a bill in Congress right now that could change how those programs are funded entirely. And I'm going to end with the one habit that protects you against all 4 of these at once, regardless of which way any of them eventually goes. My name is Kevin. I read the rules so you do not have to. Every week I go looking for the thing that quietly decides what happens to your money, and I bring it here before it costs you anything. If that sounds useful, subscribe and turn on the bell, because 2 of these 4 are actively being argued about in court and in Congress right now, and whichever way they land will change what your card actually costs you. Trap number 1. The late fee that was supposed to shrink to $8. Let me give you the full history, because the ending is not where most coverage stops. In March of 2024, the agency that regulates consumer finance finalized a rule capping late fees at large banks at $8. Before that, the typical charge was $30 for a first late payment and $41 for every one after. The agency's own estimate was that the change would save American households around $10 billion a year. Within days, banking industry groups sued in federal court in Texas, arguing the agency had exceeded its legal authority. A judge blocked the rule before it ever took effect. Then the administration changed. And here is the part almost nobody knows. The same agency that wrote the rule stopped defending it in court. It joined the banks in asking the judge to throw the rule out entirely. In April of last year, the judge granted that request. The rule is not paused. It is not under appeal. It is dead, and it was killed with the cooperation of the agency that created it. So today, if you are late, you are almost certainly still looking at $30 to $41. Now here's why I am not finished with this one. In July of this year, financial news outlets reported that the same agency submitted a new request for information on late fees to the White House's Regulatory Review Office. A request for information is typically the first formal step before a new attempt at rulemaking begins. Nobody serious expects an identical $8 cap to survive a second attempt, given what happened to the first one. But the fact that the subject has been reopened tells you this is not finished. And it is worth knowing that when a headline eventually says something changed, you will already understand what actually happened the first time. And there is a detail inside the legal history that explains why the second attempt will likely look different from the first, which is worth knowing so you are not caught off guard by whatever comes next. The court that struck down the original rule did not simply say the agency was too aggressive. It said the $8 figure itself failed to meet the legal standard written into the underlying law, which requires penalty fees to be reasonable and proportional to what a late payment actually costs the bank to process. That is a specific legal finding, not a general objection, which means any future rule will likely have to show its arithmetic far more carefully than the first one did. and that kind of rulemaking takes years rather than months, so do not expect a fast resolution either way. This is a multi-year story, and the honest position right now is that you should plan around the fee that is actually being charged today, rather than the one you were told about 2 years ago. So here is what to do about it today, regardless of what happens next in Washington. Set up an automatic payment for at least the minimum on every credit card you hold. Not the full balance necessarily, just the minimum. This is not about spending less. It is about making sure a fee never triggers because you were traveling, or unwell, or simply forgot a date on a calendar. You can still pay more by hand whenever you want. The automatic minimum is an insurance policy against a $41 charge for nothing more than timing. And here is the part that surprises people every time I say it. If a late fee does land on your statement, telephone the number on the back of the card and ask them to remove it. Most major issuers will waive a first late fee on an account with an otherwise clean history, with no argument and no lengthy explanation required. It is one polite phone call. And the reason it works so well is that keeping you as a customer is worth more to them than $41, and almost nobody ever asks. Let me tell you about Pauline. Pauline is 74, and she has never in her life missed a credit card payment. She is proud of that, and she has earned the right to be. 2 winters ago, she was in hospital for 11 days with pneumonia, and a payment came due on the 4th day. Nobody was checking her mail. The payment posted 6 days late. She came home to a $41 fee on a card she had held for 19 years, and her first instinct was to simply pay it and move on, because that is what a careful person does with a bill. Her granddaughter, visiting to help her recover, picked up the phone instead. 15 minutes on hold, a short conversation, and the fee was gone. Not reduced, gone. Pauline had held that card for 19 years and never once knew that a phone call could undo a fee that had already posted. Not because anybody hid it from her, because nobody had ever had a reason to mention it, until a hospital stay made it matter. That is the reason the quiet rules exist in the first place. Plain English, printed large enough to read without hunting for your glasses, on the handful of things that quietly decide what happens to your money. The exact words that get a fee waived, what is actually protecting your credit report and what is not, and the one habit that keeps you safe no matter which way any of these 4 things eventually go. So that nobody pays a fee or loses points or takes a hit to their score over something that was always avoidable. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on a television right now, there is a code on the screen you can point your phone camera at. 7-day guarantee, always. If it does not hand you something you did not have before, you send it back. So here's a question worth sitting with. When did you last actually telephone your card issuer and ask for anything, rather than simply accepting whatever the statement said? Trap number 2, medical debt on your credit report and the gap inside a genuine improvement. This is the one where the most damage is being done right now, because the headline people remember is more generous than the actual rule, and the difference is costing real scores. Here is the accurate picture. The 3 major credit bureaus adopted voluntary policies, not federal law, to stop reporting certain kinds of medical debt. Under those policies, medical debt that has already been paid off will not appear on your report. Medical debt under $500 will not appear, and medical debt that is in collections but less than a year old will not appear either. Now listen carefully to what is missing from that list, because this is where people get hurt. Medical debt over $500 that remains unpaid, and that has been in collections for more than a year, can still appear on your credit report, and it can still damage your score significantly. And these bureau policies are voluntary. They are not backed by federal law. A federal rule that would have made these protections permanent was struck down by a court last year. Which means the protection you are relying on exists only because 3 private companies have chosen so far to honor it. Not because a statute requires them to. There is genuinely good news buried in here, and I want to give it to you properly rather than rushing past it. A number of states have gone further than the bureaus and passed their own laws banning medical debt reporting outright, regardless of what happens at the federal level. If you live in one of those states, that protection does not depend on any company's goodwill. It is written into your state's law, and it holds whatever a court in another state decides. And there is a second piece of quiet good news. The newer scoring models, the versions increasingly used by lenders, weigh medical debt considerably less than the older ones did, even when it does appear. So the same entry that would have hurt you badly a decade ago may barely move the number a lender actually sees today. Here is what to actually do. Go to the one official site mandated by federal law for free credit reports and pull all three from all three bureaus. Look specifically for medical debt entries. If you find one over $500 that you believe is inaccurate, already paid, or older than it should be given the rules I just described, you have the right to dispute it directly with the bureau at no cost, and they are required to investigate within 30 days. If you find one that is accurate and genuinely unpaid, prioritize the ones over $500 that have been sitting for more than a year, because those are the ones actively working against you. A little more on how to actually run that dispute well, because the difference between a dispute that works and one that gets rejected usually comes down to paperwork rather than the underlying facts. When you file it, do it in writing rather than only over the telephone, because a written dispute creates a paper trail the Bureau is required to respond to formally. State plainly what is wrong. It has already been paid, and here attach the payment confirmation. It is under the $500 threshold. It has been in collections for less than the protected window. Whatever the actual reason is, name it specifically rather than simply writing that the entry is wrong. A bureau investigating a specific claim moves considerably faster than one trying to guess what you are objecting to. And keep a copy of everything you send, with the date, because if the first dispute does not resolve it, you are entitled to escalate, and having your own paper trail is worth more at that point than anything the bureau's system shows on its end. Let me tell you about Garrison. Garrison is 69, and 3 years ago he had a procedure that left him with a hospital bill he genuinely could not pay in full. He set up a small payment plan directly with the hospital and has been chipping away at it faithfully ever since. He assumed, because he had heard the headline about medical debt disappearing from credit reports, that none of it could touch him anymore. He stopped checking. The bill was $1,400. It had been in collections for over a year before he even set up his payment plan. It was never covered by the paid-off exception because it was not paid off. It was never covered by the under 500 exception, and the 12-month window had already closed before he started paying. He applied for a modest loan to help a grandchild with a car, and the interest rate offered back to him was considerably worse than he expected, entirely because of an entry he believed no longer existed. Garrison was not careless. He heard an accurate headline and drew a reasonable conclusion from it, and the conclusion happened to be wrong in a way that cost him real money at exactly the moment he needed the better rate. That is exactly the gap this guide closes. Not to make anybody a credit expert, to put the actual boundary of each rule, not the headline version of it, in one place, so a person checking their own report knows precisely what should and should not be there, instead of trusting a sentence they half remember from months ago. Same place, kevinexplains.shop, link in the description and in the pinned comment at the top, and the code on your screen if you are watching this on the television. 7-day guarantee, no argument. A man with a payment plan he is honoring faithfully, discovering at a loan desk that the protection he believed in never actually applied to him. Trap number 3, the payment method that stopped being invisible. This is the one catching people off guard hardest because for years the entire selling point was that it did not touch your credit at all. Buy now, pay later services let you split a purchase into installments, often with no interest over a short term. For a long time, one of their biggest advertised advantages was that they were invisible to the credit bureaus. Use it, pay it off, and your score never knew it happened. That has changed. Starting last year and expanding through this one, the major buy now, pay later providers began reporting account activity to 2 of the 3 major bureaus. Every new account you open can appear as a fresh credit inquiry and can lower the average age of your accounts. A missed payment can now be reported as an actual delinquency rather than disappearing quietly. And multiple open accounts running at once can affect how your overall credit utilization is calculated. For somebody who has spent decades carefully building a strong score, this is a genuinely silent threat, because the entire habit was formed around a rule that used to be true and no longer is. Here is the practical instruction, and it matters most if you have anything large coming up. If you are planning to apply for a mortgage refinance, a home equity loan, or a car loan within the next year, avoid opening any new buy now, pay later accounts during that stretch. The timing could not be worse, because a lender pulling your report right when several new short-term accounts have just appeared sees exactly the pattern that makes them hesitate. And there is a second detail worth knowing if you already use these regularly. Missing a single payment on one of these plans no longer stays a private matter between you and the retailer the way it used to. It can now be reported as a genuine delinquency, sitting on your credit report the same way a missed credit card payment would. So if you are juggling several of these at once, the discipline that used to only matter for actual credit cards now matters here too, and treating them as casually as a layaway plan is no longer accurate. One more practical piece before I move on, because it applies to nearly everybody watching, regardless of whether you use these services. When a card issuer changes the terms of your account, the interest rate, a new fee, a change to how rewards work, they are generally required to notify you in advance, usually around 45 days before the change takes effect. That notice arrives as a single paragraph, often buried inside a longer mailing or an email you might reasonably assume is routine marketing. The habit that catches these before they cost you anything is simple. When an envelope or an email from a card issuer says anything about a change in terms, read that specific paragraph rather than filing the whole thing away unopened. It takes under a minute, and it is the only reliable early warning you get before a change actually reaches your statement. And trap number 4, which I want to cover in the same breath because the underlying lesson is identical. Your rewards. The points and miles a great many of you have been collecting for years, sometimes decades. There is a bill that keeps being introduced in Congress called the Credit Card Competition Act that would require the large card networks to let merchants route transactions through a competing network, similar to what happened with debit cards back in 2010. Card issuers argue that if this passes, the fees that currently fund rewards programs would shrink, and they would respond by cutting back the very points and miles you have been saving. The bill has not passed. It may never pass. And I want to be fair to both sides of that argument, rather than only giving you the card industry's version. Supporters of the bill argue that competition among payment networks would lower the fees merchants pay, and that some of that saving would eventually reach shoppers through lower prices, the same way debit card fee reform was argued to help retailers years ago. Opponents argue that rewards programs are funded directly by those same fees, so squeezing one side inevitably shrinks the other. Both arguments are being made in good faith by people who genuinely disagree about where the money actually ends up, and the honest answer is that nobody knows for certain until it is tried. But here's the sentence I actually want you to remember, and it has nothing to do with whether that specific bill succeeds. The points sitting in your account right now are not money. They are an unsecured benefit that the card issuer can modify, devalue, or eliminate at any time under the terms you already agreed to when you opened the account. That is true today, regardless of what Congress does next. So the practical response is simple. If you have been holding a large balance of points or miles for a big redemption you keep putting off, waiting for the perfect trip or the perfect moment, understand that every year you wait is a year the value of what you are holding is not guaranteed. Using what you have already earned is generally the stronger position than indefinitely hoarding it against a future that may never arrive on the terms you are hoping for. And one more thing on rewards worth knowing, aimed specifically at anybody watching who is rebuilding credit later in life, perhaps after a divorce, a bereavement, or simply having let a card lapse for years. A secured card, where you put down a deposit that becomes your credit limit, is often dismissed as a beginner's product, something for young people starting out. It is not. It reports to all 3 bureaus exactly the same way an unsecured card does, and for somebody whose file has gone quiet, it is frequently the fastest, cheapest, and most reliable way back to a strong score, without any of the 4 traps I have just described attaching to it in the same way, because the limit is small and the terms are simple by design. If that describes your situation, it is worth 2 minutes at your own bank asking whether they offer one, rather than assuming it is beneath where you already are. Let me tell you about Yolanda. Yolanda is 71, and she has been saving airline miles for 12 years toward what she calls the real trip, the one to see her sister in Portugal, business class, done properly, someday. She has enough miles sitting in her account right now to book that flight twice over. Twice, since she started saving, the airline has changed how many miles a business class seat actually costs, and both times the number went up. Not because anybody stole anything from her, because the program, like every rewards program, was never a fixed price list. It was always subject to change by the company that runs it. She still has not booked the trip. The someday keeps moving further away, not because her sister moved, but because the target itself has been quietly moving the entire time she was saving toward it. Now let me give you my honest opinion, which is only that, and you are welcome to disagree with me in the comments. But before that, one more thing about old debt specifically, because it connects directly to everything I have just told you, and it is worth knowing on its own. Credit card debt, unlike the federal student loan debt I have covered in other videos on this channel, does have a statute of limitations. Depending on your state, a card issuer or a debt collector generally has somewhere between 3 and 10 years to sue you over an unpaid balance before the legal window closes. After that window, they can still ask you to pay, but they generally cannot successfully take you to court over it. Here is the trap inside that. If you make even a small payment on a very old, expired debt, or in some states simply acknowledge in writing that you owe it, that action can restart the clock on the statute of limitations, sometimes from zero. Collectors who buy old debt for pennies on the dollar know this well, and a friendly-sounding call offering to settle an old balance for a fraction of what is owed is sometimes designed less to collect money and more to get you to say the word yes on a recorded line, which restarts the legal window and makes the debt collectible again for years. So if you are ever contacted about a credit card debt that is genuinely old, find out first whether it is still inside your state's statute of limitations before agreeing to anything or making any payment at all, even a small one. That single piece of information changes everything about how you should respond to that call. Now let me give you my honest opinion, which is only that, and you are welcome to disagree with me in the comments. Look at what connects all 4 of these, because it is the same thing every time, and once you see it, you will spot the next version yourself without needing a video to point it out. In every single case, a genuine consumer protection was announced, loudly, with a clear headline. And in every single case, the actual protection that survived was narrower, more conditional, or entirely voluntary compared to what the headline led people to believe. The $8 cap became $30 to $41 again. The medical debt protection became a set of specific exceptions rather than a blanket rule. The invisible payment method became a fully visible one. And the rewards you assumed were yours to keep were never actually guaranteed at all. I am not going to tell you that is a deliberate trick played on seniors specifically. It is not. It is simply how modern consumer regulation tends to work. A rule gets proposed, industry challenges it in court or in Congress, and the version that survives is usually thinner than the version that made the news. That happens across every area of financial regulation, to every age group, and it happened 4 separate times in the same corner of your wallet within about 2 years. My actual objection is narrower than the regulation itself. It is that nobody circles back afterward to tell you what actually survived. The headline runs once, when the rule is announced. The correction, when it gets vacated or narrowed or quietly changed, almost never gets the same coverage. And it is exactly the correction that determines what you are actually paying and what you are actually protected from. And I think there is a reasonable question buried in all 4 of these that is worth asking honestly rather than dismissing. Why does the corrected version so rarely reach the same audience as the original announcement? Part of it is simply how news works. A new rule is a story. A rule being quietly unwound in a Texas courtroom months later competes for attention against everything else happening that week and usually loses. Nobody is deliberately keeping you in the dark. The correction is published. It simply is not amplified the way the original promise was, and the difference between published and amplified is where 4 separate traps in your own wallet have been quietly sitting. So the only reliable defense is the one habit that works regardless of which way any of these 4 eventually resolve. Check the actual current rule yourself, roughly twice a year, rather than trusting the headline you heard once and have been carrying around ever since. Before the scam warning, one more thing worth knowing, because it ties all 4 of these together in a way that protects you generally. Read your monthly statement properly, not just the total due. Look at the interest rate charged that month against what your card agreement says it should be. Look for any new fee category that was not there the month before. Card agreements can change with proper notice, and the notice is often a single paragraph mailed or emailed months ago that most people never read closely. 5 minutes with your actual statement, twice a year, catches far more than any single piece of legislation ever will. Now, before the checklist, a warning, because a video like this one draws exactly the kind of attention scammers look for. Nobody legitimate will ever telephone you offering to get your late fees permanently capped, your medical debt erased, or your rewards points protected for a fee. Every single thing described in this video is something you can do yourself, for free, through your card issuer, the credit bureaus, or the official government dispute process. There is no paid service with access to a protection you cannot access yourself. And if anybody calls asking you to confirm your card number, your account number, or your social security number to apply any of what I have described today, put the phone down. Then contact your card issuer directly, using the number printed on the back of your own card, never a number a caller gives you. There is one more version of this scam worth naming specifically because it is dressed up to look exactly like the helpful information in this video, rather than an obvious threat. It offers to check your credit report for medical debt errors on your behalf, for a fee, or to file disputes for you for a percentage of whatever gets removed. Every one of those services is doing something you are fully entitled to do yourself for nothing, using the free official site and a free written dispute. Paying somebody to send a letter you could send yourself is not fraud exactly, but it is money spent on nothing. All right, here is your list. 5 things, and every one of them takes a phone call or 10 minutes online. 1. Set up automatic minimum payments on every credit card you hold, so a late fee never triggers over simple timing. 2. If you are ever charged a late fee, telephone and ask for it to be waived. It works far more often than people expect, and it costs you nothing to ask. 3. Pull your credit reports from all 3 bureaus at the official free site and check specifically for medical debt over $500 that is unpaid and older than a year. Dispute anything that looks wrong in writing with the specific reason stated. 4. If you use buy now, pay later services, avoid opening new accounts in the months before applying for a mortgage, a home equity loan, or a car loan. 5. If you are sitting on a large balance of rewards points or miles for some future redemption, consider using a meaningful portion of them sooner rather than later, because the value is never guaranteed to hold. And if your own situation is tangled, if you are looking at a statement or a credit report and cannot work out what actually applies to you, write to me. The address is on your screen and in the description below, and I read every one that comes in. Tell me which of the 4 traps concerns you most, because that tells me exactly where to start. One last thing before you go. Pauline held a card for 19 years before she learned a single phone call could undo a fee that had already posted. Garrison trusted an accurate headline, drew a reasonable conclusion from it, and paid for the gap between the headline and the actual rule at exactly the moment it mattered most. And Yolanda has been saving toward a trip for 12 years, watching the target quietly move further away the entire time she believed she was standing still. None of the 3 of them did anything a careful person would not have done. Every one of them was operating on the version of a rule that was true once and had quietly stopped being the whole story. And that is really the entire subject of this video, said plainly. Not that credit cards are dangerous, or that the companies running them are out to get you. It is that the rules governing them move considerably faster than the news coverage explaining those rules does, and the gap between the two is measured in months or years rather than days. A headline runs once. The correction, if it ever comes, runs quietly, to a much smaller audience, long after most people have stopped paying attention. So go and check this week. Read your actual statement rather than skimming the total. Pull your actual credit report rather than assuming you remember what is on it. And the next time you hear a headline about a rule protecting you, remember that the headline is only ever the beginning of the story, and the ending, the part nobody covers with the same excitement, is the part that actually decides what you pay. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.